Hello, everyone. Can you hear me? Hi. Hi, Kayla. Good to see you. Can you hear me?
Hello, yes, I can hear you.
Oh, the party's here. What's going on, guys? Especially anytime Caleb is here, it's a big party.
Kayla.
How you doing?
Yeah, good to see
Good to
everyone.
go.
We want to make this meeting today to make it more like conversational and interactive. So feel free to turn on your camera or ask any question between. And our presentation gonna begin at 12:15. Which is in another 12 minutes Eastern time. So, who, Camila is here, Pramod.
Hello.
Hey,
What's
hi.
up, guys?
Hi. Hi, Pramod.
Hi, how are you?
Yeah, good. How are you?
Very good.
Yeah, good to see you. Just only talk to you on the phone, but so glad to see you in
Sure,
person.
likewise.
Oh my.
Why don't we switch seats? You look better than.
No, because I look fat even in the phone.
Well, they can see my receding hairline. I'm very self-conscious about it.
No, so you're fine. And I'm very excited that everybody is joining, and thank you so much for joining today. We're going to have our speaker coming at 12:15 Eastern time, and as just in case that many of you don't know yet, we are going to talk about oil and gas. Oil and gas investment opportunity. It's right now it's like a good time to get into buying, wells because of and our speaker today he's gonna go over it. And hi, Anshul.
Hi, Patra. How are you?
Good. How are you? Thanks for joining, and good to see you.
Absolutely. Thank you for having me.
Yeah.
Anshul, he's also a CPA.
Also, if anyone's interested, I was doing a lot of research last night on this topic. Wanted to dive into this for a long time now. And I'm doing a presentation that's exclusive for our clients, but if you're interested, I'm going to put the link in the chat. And the topic is turning your hobbies into legitimate business activities and tax deductible opportunities. So, for instance, we're going to go into what the tax law says and how can we take our hobbies and passions and turn them into legitimate businesses where we can now write off things that we're doing for fun. So that's at 4 o'clock. I'll put it in the chat in case anyone's interested.
Yeah, Mark, you want to introduce yourself a little bit who you are?
Hey, my name is Mark Proberg. I'm a CPA, run a practice here in Atlanta. I specialize in advanced tax reduction strategies.
Yes, and I am Patra Francis. My background is also in taxes. I am a tax strategist, and I am also a real estate investor. So that's the reason why we create a passion project to do our meet up every month. So
By the way, Zipporah, Patra always calls you Zipporah. I thought that your name had the exact same pronunciation as the makeup store for like maybe the first month I knew you.
My name is exactly like the Jewish Zipporah.
I didn't know that Zipporah was a Jewish name.
It is.
Who is Zipporah? What does that mean?
Moses' wife.
Ah, very cool.
Yeah.
yeah.
Do you ever call your husband Mo?
You know what? I told him I'll look for a second husband named Moses so we can all be in balance. But my brothers are on the line and my sister is here too today. So I'm excited.
Awesome. What's up, you guys?
Which one is it, Sephora? Ruth. Yeah, I see Ruth. Her name.
And Samuel and Caleb.
Hi, Samuel. Hi, Caleb. Oh, that's your brother. I see.
Patra, in case anyone's interested, if you want to put this in the chat so I don't have to sign in, I'm gonna just email it to you. And so I'm all about embracing what I call the tax-free lifestyle, where you're doing things you enjoy and writing it off on your taxes. So if you could find a way to do something like we were talking about my client who's really into duck hunting. How can we turn his duck hunting hobby and passion into a legitimate tax deductible activity? And so in case you're interested, now if you're not, don't do it. But I'm going to go into what the court has said. You know, a lot of people look at this as an excuse to write off horse. It seems like horse breeding is a really common scheme people try to write off on their taxes. So we'll talk about how the tax law applies and how to get that deduction in case anyone's interested.
I got your link, so I was going to.
Here's a really good tax reduction strategy is if you date another business owner and you're a business owner, like then you get to write off a lot of your meals together. So, you know, I don't just date Patrick for the tax savings, but we do write off a lot of our meals and activities and travel together.
Right. Where is you're gonna tell people like what time? Because you only send me the Zoom link, doesn't have information on it.
Yeah. Oh yeah, but it's at 4 p.m. EST. You just put in the chat 4 p.m. EST.
And the topic is how to write off. You write off your hobby.
Turning your hobbies into. They get the point. They heard me talk about it. Yeah, 2 more people that want to join. No, it's at 4.
4 p.m. Eastern time, right?
Yeah, 4 p.m. EST. How's that?
Today in Atlanta it's raining, so we recording instead of coming in person, that is, I think it's easier and more convenient to join on Zoom. So many of us have to join on Zoom today. D. Maybe we can do some icebreaker a little bit. Mark,
Okay, what we're gonna do.
we have 5 minutes.
All right, everybody has 10 seconds to introduce it, to say who you are, what you're doing, and when you had. But it has to be 10 minutes. It has to be fast. No autobiographies here. All right. So I'm going to start off. My name's Mark. I'm a CPA. My big win is our team is crushing it. We already completed like 5 tax returns. Last year we only did like 1 by this time. That's all we. Patrick, what you got?
Can you have somebody else? I already introduced myself.
Okay. Caleb, what's going on with you? All right, how about Camila? You know, if you,
Hey everyone, and I'm sorry I'm not on camera. I am not camera presentable today.
Not
But,
judgment here.
But I am Camila. My practice, I have a CPA practice in Atlanta. I do taxes, bookkeeping, CFO, all that fun stuff. And I am, my office is College Park.
tell us about a win.
Hmm?
What's a recent win for you?
Oh, say that again. I'm sorry, I couldn't hear
What's a
you.
recent win for you?
Oh, a recent win. So I pitched a tax planning service to a guy who has a business, a really great business, and he wants to sign up. I just pitched it on
Nice.
my Tuesday, and yeah, he's said he's going to sign up. I sent him the engagement letter and just waiting to get that back.
Awesome. Good to hear that.
Very cool.
Yeah,
I'm
thank
gonna
you.
I'm gonna recognize a win for someone here. We got Syed Rafi, who's one of our accountants. He just survived the scrutiny of 2 of our reviewers on an S corp return. That was not easy. So congrats to you, Syed.
Thank you so much, Mark.
And Syed is out of Brooklyn.
And who else you wanna promote? You wanna be the next one to introduce yourself?
Oh yeah, hi everybody. I'm Pramod. I'm based out in Washington DC area, so I am new to this race masters, and in the past Last year, I did a syndication and own a couple of multifamily properties all across, in some of the states, 3 or 4 states.
Thank you, Pramod. I know Pramod from because we are working on a project, our last project together. We helping Hunter Thompson, who he owned Asset Capital, and we raised on the 71 unit apartment together. So that's how we get to know each other, and that's why I invited him here to talk, to understand more on the oil and gas because it gives you very good return of investment, also give you tax benefit as well. And I mean, today we are going to talk about the opportunity, which is it's gonna be in 2 minutes. Just stay tuned, okay? But maybe you can take
I want to
concept and foundation.
Okay, well, one idea, for you, Paramount, and for some of you folks that are interested in real estate and oil and gas pair really well together, especially if you're passive, because your oil and gas has a very fast velocity of cash. Cash comes back fast. And you're going to see, you do get a lot of tax deductions, which is great. But let's say you stop putting the money back into the oil and gas or the wealth starts to compound. Eventually, you're going to have passive taxable income tax at your ordinary rate. But that's okay. Because if you're investing in real estate, you have all these passive losses. You may not have as fast of a cash flow all the time. Might have some good refis. But you can now use those real estate losses that you weren't using otherwise, and they're going to offset the profit from your oil and gas. So it's like you're building up this reserve of passive losses. You're not paying taxes on real estate profit, but maybe the money isn't coming in as fast because they're doing all these renos. And then the oil and gas brings in the money, and then the real estate brings in the tax deduction to offset it. You don't need real estate professional tax status or anything fancy. You could be a regular W-2 and still use those passive losses. So you have tax-free income from both sources now.
Yeah, you don't even have to do like a minimum of 100 hours.
None of it matters. Yeah.
In order to get a deduction. So I think that this is a great
to have profit in that passive bucket.
Yeah, sure. That's what I'm pretty excited to, look forward and to hear today's presentation.
Yeah, awesome. Thank you, Pramod. And what about Anshu, you want to introduce yourself? You are the next person directly Pramod on my screen.
Sure. My name is Ashil, and I'm a CPA out of Los Angeles, California. I have a practice, One Solutions, and we provide accounting services and CFO advisory services. And I'm also getting more into tax planning strategies, and that's why Patra thought it would be good to join this session. I'm excited to learn more about this opportunity.
Cool. Akil, are you in CTC?
I'm sorry?
Achille.
Akil, are you in AICTC?
AICCC. What is that? No,
American Institute of Certified Tax Planners?
No, not yet, but I'm curious to learn more about it. I'm not familiar with it.
Yeah, you should check out joining and tell them I sent you. I'm going to be actually an instructor at the Orient when in October, I'm going to help instruct the certification class. I'm going to talk a little bit about I think passive income and cost segregation in real estate.
Yeah.
Do you mind sending maybe the name or something in the chat?
I can text you. There are other people joining. I didn't see. I can text you, and I can tell you more about it too.
Okay, great.
I think it's a great place for you to, if you're looking to start your tax planning, that would be a good place to start with. And anyway, it looks like our speaker is here now, Mike. Thank you so much for joining again. He was our speaker from last event, and he's back in, which is I'm very grateful for it. And I know that everyone here so excited to hear about this topic. Mike, maybe we can get started then.
I want to say something real quick. You see that what Mike has on his jacket right there? What does that say? That means you get to write off your sweater jacket theme. So
That's exactly right.
Put a logo on it. You can write it off. I'm not sure if you can get away with doing that on your underwear. You gotta show that it's promoting your business and no one's looking at your underwear unless you have a certain profession. But I just want to point out he's writing off that nice jacket he has there. It looks comfortable.
I'm a finance underwear model. That's how we get away with it, right?
Yeah.
Very interesting.
And I mean, this is not a requirement. If you can turn your camera on, that would be great. But if you can't, that's totally fine. But I would love to see familiar faces here. So, and keep it, interactive.
Yeah, let's hear it.
Thank you, Sai.
Awesome. Well, appreciate you having me back on. Good to see you guys. Good to see everybody. So what we're going to talk about today is our latest oil and gas fund. I know, obviously, Patra, you and Mark have been eagerly awaiting this and have a lot of interest in this asset class. So we've officially arrived. So we're going to spend about 30 minutes here working through the presentation, and then and leave plenty of time for Q&A, and we'll kind of keep things rolling from there. So I think we got.
And one of the reasons why I invite Mike to be one of us, to be our speaker today, because I very like the unique strategies that he has in his firm. It's unlike other oil and gas strategy because it's a lot safer, and you're gonna hear why, and also high reward as well. So.
Awesome. Well, I'm gonna share my screen here. Can everybody see this okay?
Yes.
Okay, awesome. Well, again, I appreciate you having me here. So again, my name is Mike Sullivant. So I head up investor relations, capital development at Aspen Funds. We're an operator and investment firm based out of Kansas City, and have a number of diversified asset classes and partnerships with folks like yourselves. So we're excited to introduce the 51 Upstream Energy Fund 7. So this is again an institutional grade diversified oil and gas fund that we'll kind of get into the meat of this here as we go through. So as always, disclaimer: we're going to make some. This is not an offer for securities. You'll have to consult, PPM. I know Patra, you plan to partner with us and have an SPV available for your investors. So obviously, always consult with the PPM. Their forward-looking statements, of course, confidentiality. Please don't redistribute this. This is for kind of informational purposes only, and we'll kind of move along. So, executive summary: what we're doing here is investing into existing production. So this is buying into what we call PDP. So these are proven, developed, and producing wells. So these are wells that are already being operated. They are validated in their geology, and they have engineering reports and production reports to kind of validate that they are in fact proven and that they are in fact producing. So that's kind of the designation is P, proven. Developed and producing means that they're already built and generating minerals. Then you have what also on an upside in a fund like this is development of PUDs. So these are proven undeveloped locations. So eventually they become PDP, but initially they're PUD because they have not been developed. So that's what this fund is doing. It's buying into existing, layering in additional PUDs, which compounds cash flow and creates some upside. So these are all in basins where there's already kind of large operations that are happening. These assets are alongside major operators, which we'll get into some more detail there. Specifically, what we're purchasing, the majority of this fund is what's called non-operated working interest. So this is in the oil and gas industry. You have mineral rights. You have an operator who has a lease, and they have the working interest, which is basically the right to drill. And what they've done is split the interest in that lease and created non-operated working interest. So that's what we own. We're not the operator. We're not out there doing the day-to-day drilling, but we have a percentage of ownership of that lease and the production that comes from it. So that's what that non-operated means. There's potential for overriding royalty interest. So the fund, it has the ability to purchase that, but the majority of what we'll be purchasing is non-operating working interest. So the reason we do this is it substantially reduced risks because you're alongside major operators who are very sophisticated, and you're buying into something that again already exists and is producing. So,
I think Mark has a question.
What does PUD
yeah,
stand for?
Proven undeveloped.
Gotcha.
So it's a new development, right? New development.
Yep,
Got it.
it's a well that has the proven geology. So these are infill wells, meaning so you have call it you have a field, and so you have 100 wells. There's 50 wells that are PDP, so they're proven, developed, and producing, and then you got say another 50 that are PUDs. They're proven, meaning they've been validated by the geology. They're validated by the production of these existing wells, but they just haven't been drilled yet, and that's effectively what that is.
You know, we get a lot of people who I talk to about these things. Like, hey, there's no really amazing tax savings here. And they're like, well, what if there's no oil? I don't see oil. Like, how are these guys doing their oil? They don't realize that this is something that's been refined over hundreds of years.
Absolutely, absolutely. Yeah, and that proven, that P in front of those, proven, is an actual designation in the industry. So in order to actually call it a PUD or call it a PDP, has to be a substantial amount of geological data and production data to validate that. So it's not, you can't just say, oh, this is a proven well. It actually has to, it's a designation. So it's a major way to reduce risk when you're doing oil and gas investment. So we're going to talk kind of some trends here. So, first would be the Oracle of Omaha. Warren Buffett ignores Wall Street, buys more stocks in oil and gas companies. So they've spent a significant amount of money investing into, companies that are kind of directly correlated to drilling. And so they kind of see some of the thesis that we're seeing here, which is really underinvestment into an industry that politically perhaps is out of favor, but functionally is not going anywhere. And there's maintained strong demand for what we're doing. So what that creates is kind of an imbalance of supply and demand. That's what we're seeing, and obviously seeing some of the most successful investors seeing the same thing. You'd like to. So the green energy initiative, I would say, has really been pushing, alternates to carbon fuel. So you have carbon fuel can be coal, natural gas, and oil. This is kind of the current state of carbon. This is all fuels right now being consumed globally. And so this is according to statistical review of the World Energy. And basically 83% of the world's consumption is, even with the addition of non-carbon fuels, 83% is still coming from carbon fuels. So, you add other renewables, solar, wind, hydro, nuclear are making up, like solar is this, like there's another little tangent of solar that slips into here. So there's a very small sliver that's actually producing, and they're saying, oh, well, oil's gone, gas is gone, coal is dead. It's thing of the past. It's far from true. And the reality is that we need all of these carbon fuels to actually get to develop the new technologies, get to the place where, we have renewable sources of energy, but we're decades away. And so we can't just jump off the cliff. And I think a lot of people are jumping off the cliff of, hey, it's dead. Well, I'm just going to go get into some of these other alternative non-carbon fuels. And the reality is the technology's far from there, and the infrastructure can't even support. So we can get into some more details there. But one of the interesting things you'll see is, for those of you that have been watching Landman, this really is kind of telling the story and highlighting, the illogical nature of, I would say, a political ideology that is pushing that, hey, we don't need carbon-based fuels. We're gonna move on without it. Everything's gonna be an electrical vehicle. Solar is gonna power us. All these alternatives are gonna power us. And the reality is that this is not going anywhere, and it's only getting bitter. And when you constrain supply, it gets more expensive. So there is a good example would be, there's a clip, and I don't have it in this presentation, but there's a clip from Landman where he's talking with somebody who kind of, I would say, subscribes to that ideology, and is talking about a windmill, and he proceeds to explain the illogical nature of windmill, that in its lifetime of 20 years, that windmill will not even become a net neutral of its carbon use because of the amount of carbon that's used to develop it, to transport it, to maintain it, and then eventually to replace it when it goes out of life. It's those are some good examples of why there's kind of some misconception here. And yeah, so again, this is not going anywhere. We've got decades ahead where fossil fuels are going to continue to be needed, and fossil fuels long term are really not going anywhere in a sense of they're always going to be useful. They're always a component of our total energy consumption, and it's going to be needed to to create some other renewable sources. Oil and gas, again, supply constraints, so production from existing fields declines, between 2 to 5% every year based on depletion. So once you extract it out of the ground, it gets consumed, not renewed. So that's what depletion is. So we need, 5 million barrels a day of new production just to maintain a flat supply. So if we're today, we need to add 5 million barrels per day of new production that we're developing to keep things static. As a result, global energy production is severely supply constrained with no prospect of rapid increase. So when you take it offline, it's not a switch that you can just flip a switch. This is very capital intensive. It takes years to develop infrastructure, to develop wells, to get to a place where you were at where you stopped producing. So it's important that there's continuous investment into development to maintain supply and ultimately bring new production online. This is JP Morgan. They're predicting a $7.1 million barrel per day shortfall by 2030 based on current investment. And so they're kind of mapping out, a number of different resources, OPEC being one of those of what they're projecting in terms of demand for oil supply. And yeah, we're unfortunately in a time where we're going to see over the next 7 years, 5 years, call it, we're going to see prices continue to climb if there's not, a significant investment in this space. And I don't think much is changing there. So why this opportunity is unique is we can kind of get on the other side of the pump in a sense where because there's underinvestment, because there's kind of political pressures against very large institutional capital, it's creating this gap where private capital can step in and take advantage of the inefficiencies, take advantage of the gap in capital, and bring private capital to go and take advantage of the imbalance. So again, this issue is not going anywhere. You're seeing demand. Here's your demand line. So if you see demand right here and you see supply right here, you're seeing a massive gap here as we head into the future.
Hey, Mike, I just want to point something out that we see. So we help our clients do solar, start solar businesses, and they invest in panels and rent them out. And now it's not like an either or. The thing is that the solar businesses have like a profit margin of like 1%. There's like almost no profit on these things because it's not economically efficient at all. And the only reason this makes sense is because of tax credits created by the Inflation Reduction Act. And there's a possibility we will lose those tax credits under Trump because they want to, basically they want to finance some other initiatives here. So if that's the case, there's like absolutely no remaining incentive to do stuff with solar as a big business owner because the only real reason is because of these credits that we may even lose in the future. But like if you're thinking profit, what we've seen across the board from a lot of these solar guys, so little profit on these things.
It doesn't generate enough energy. That's the issue. So it doesn't create enough energy. And the other thing, it requires quite a bit of real estate. Like it takes a valuable real estate. I mean, it's, it can be a component always. And I think that there's, we need to think about energy in terms of, these are all resources that collectively make up a supply. But ultimately to look at this and say, hey, we need to stop oil production and we're going to replace it with solar is just, it's illogical. That it doesn't have enough energy output. It's not dense enough to capture enough energy. And you have only there's certain regions where it works. If you're up north, wintertime is cold, and there's not going to be any solar that's available. So there's kind of uniqueness and nuances to specific geography where it makes more sense, but particularly as a full replacement, it doesn't make a lot of sense. So good point.
It's still great for
Opportunity.
taxes.
Yeah, that's what exactly. If you got them, then if you got that, then absolutely, yeah. So your opportunity to capitalize price shock in 2020 and continue focus in ESG investments, have a huge gap in funding for new drilling. So for those of you not familiar with ESG, this is environmental social governance. Basically, for any publicly traded financial institution, they get grades basically based on how conscious they are with their investment in light of, I would say, that political ideology. So pension funds, for example, have had to they've dominated oil and gas for a very long time. They've had to massively scale down their investment in this space because of ESG requirements. So I think Trump will see some changes there. I think will it be a full abandonment? Most likely not, because I think a lot of folks are bought in. But at the end of the day, that's what's creating this big gap, is the large capital has fled, and this is what I was talking about earlier. This is creating kind of an opportunity for retail investors to bridge the capital gap. And so we say drill, baby, drill. That's we can talk about that a little bit. I think ultimately is more. I would say Trump is going to be a little bit more friendly for the industry as a whole, but we're not necessarily going to see a massive influx of supply right out of the gate. But we definitely have a little bit more friendly administration within the industry, which will help with development opportunities. So our model. Let's talk about what we're doing and our strategy. So again, we talked about this a little bit earlier. We're buying into existing production where there's immediate cash flow. So you get to look at something that's existing, something that's producing, and then you price it in as it is today. You say, here's how much production there is today, over time with depletion, how much that's going to be in the future, and then you reverse that back into basically a discount. And then we reinvest the early distributions into new wells. So when you buy in at, say, a 20% cap rate on existing production, you take that cash flow, you reinvest it into developing additional wells, which compounds the cash flow and then also creates a lot of equity. We'll participate in new drilling. So new drilling is where, kind of to my example earlier, so you had 50 wells producing, 50 wells undeveloped. We'll go, case by case. We'll contribute additional capital on those new developments and take a share of that lease, and again that'll create a lot of tax benefit and a lot of tax efficiency for the fund, while also creating a lot of cash flow and equity. And then our objective is to maximize value and total return. So these things kind of work hand in hand, where it's maximize cash flow while also doing enough drilling to continue to increase the value of the portfolio. So that way you can kind of get a both end of, I get nice cash flow and I get a big equity bump at the same time. And we'll walk through some numbers that show you what that actually means here shortly. So what makes us different is really how we've mitigated risks. So in oil and gas, there's a lot of different strategies. What a lot of folks commonly know, particularly in alternatives, is development. Hey, we're going to go raise some money to go develop some wells, and we get these big tax write-offs, which can be nice, but we don't know if it's going to be profitable necessarily, because we don't know if it's going to hit. We don't know if it's going to work. So we've mitigated risk through our strategy by one, partnering with large established middle market operators. So these are mostly publicly traded companies, multi-billion-dollar cap type companies that are doing the day-to-day drilling. So they're very sophisticated, they're well capitalized, they're using state-of-the-art technology and facilities to do their drilling. And they're only doing this in proven basins. So that, again, that P, the proven, is a way to mitigate risk substantially. Drilling risks, we're focused on infill drilling. So, other risks that happen are when you're going to go do something more exploratory in nature, aka wildcatting. There's a lot more risk involved in new drilling. Things go wrong. Things don't go to plan. When you're doing an infill well, you have a lot less speculation. You've got a known basin, you've got a known geology, you've got known operators, and you've got success that you're building on that has already worked. Environmental risks, this kind of goes hand in hand. Infill wells are, again, already drilling in locations where there's established infrastructure, there's political, insulation, and we're not going offshore to do, you've got more risk, basically. You've got way more potential on the upside, but you don't have, the environmental risks of, hey, there's a spill, and then, the ecology gets affected, and you have liabilities that flow from that. So this is all lower 48 states, mostly going to be central states, Oklahoma being kind of a key target for us. And so you already have a lot of kind of infrastructure and insulation there. And then you have commodity price risk. So as in any oil and gas investment, you're going to have sensitivity to what price of oil is, what the price of gas is. And so a couple of things that affect this, and one is a hedging program. So hedging basically is you're buying options, and you kind of have an upward and a lower boundary of what that price of what you'd sell. You lock in a price range basically into, call it, 9 to 18 months into the future. And so it minimizes your downside. It kind of caps your upside, but it mitigates risk. So we'll have a hedging program that typically is, call it somewhere between 20 to 50% of the production gets hedged to ensure that we've got steady cash flow and you don't have as much impact from the volatility. In addition to that would be discounting. So when you buy into the existing production, for us to make a sizable return, we don't need oil to trade at $90 a barrel, for example. Like our break even is going to be, with this hedging in there, is going to be substantially lower, $40, $45. So you have a huge price insulation there through the discounting process when you buy into that existing production. So that's ways that we've really mitigated some of the key risks that are involved. Again, our focus is to democratize institutional grade oil investments. So we're making these available for retail investors like yourselves, and these are the type of operators that we're going to be partnered alongside in our existing portfolios, and then in this new fund, as we buy new assets, these are the same type of operators that will be partnered alongside. So some of these will potentially ring a bell. Marathon's a large publicly traded company. Continental, Devon, Cimarex, Soventa, these are all publicly traded companies, and so you'll find that they're very. It's a great way for us to mitigate that risk and to get kind of best in class operations. Tap into domestic oil. So again, we're focused on lower 48 states, no offshore drilling, and then we get added to the operators' insurance policies. So we kind of touched on that, I think, previously with how we're kind of mitigating risks. So there's a lot of layers of insurance, which makes liabilities to investors in this capacity very, very, very low. We're partnered with a group here in Kansas City called Mahajer Energy Advisors. So they've been advising in oil and gas. They're engineers and geologists by trade and have been advising large private equity, pension funds, et cetera, for 40 years plus. So they've been doing also funds for the last 20 years and kind of launched them at key moments. So we have a direct partnership with them. They're a co-manager of our funds, and we really rely on them for particularly the front end of analyzing portfolios, valuing portfolios, doing the due diligence at the asset level to determine what are the assets that really fit this fund and its return profile. So they've had significant results. Averaged annualized IRR historically, they've seen 46.25, their lowest being a 21.25, their highest being almost 80. So they've got a significant amount of experience there. So call it a 2-year period average, they've been averaging a 2.15x over those 2 years. So significant returns. These are some case studies of some of our assets that we have under management currently. So these are not ones that are going to be in the new fund, but these are going to give you the examples of the type of assets that we are purchasing. and we're actually circling some assets in this same region. So this is case study number one. This is one of our anchor assets in our fund that we did prior to this one. So this fund is called 51 Upstream Energy Fund 7. We had about 18 months ago, we launched the 116 Upstream Energy Fund 6. So it's kind of a previous vintage. And we purchased that asset for $30.5 million. There's 140 gross wells that were right here in the Scoop Stack. So this is a part of the larger Anadarko Basin, which is a well-known basin. And Scoop and Stack is kind of a play that's there. These are horizontal wells predominantly. And in addition to buying into these existing, we got free, we didn't have to pay for upside in a sense. We get free access to these 68 undeveloped locations that we get to kind of cherry pick. Like, hey, we like this well, we like this well, we're going to contribute capital to those new developments. So we really like it when we can buy into existing production where there is these undeveloped locations. Again, that will compound cash flow and equity. And so we've seen substantial results from this fund already. It's been producing a significant amount of income right out of the gate, so much so that we've been beating pro forma on our distributions. So we modeled in, not necessarily, I say this with a kind of caveat, we don't know that this will be the case for Fund 7, but for Fund 6, we modeled no distributions through the first year while we reinvest all the cash flows into development. We were in such a strong cash position that we started distributions 9 months early in this fund. And not only were they not 0%, they've been 15% annualized for the last 5 quarters. So very, very strong performance with no end in sight. And in fact, now that we have some of the new production coming online, it's going to start compounding and hitting into some higher cash returns. Oh, my lights just kicked off. Hold on one second. You guys still see me okay? Maybe my lights are okay. Okay, you guys can see me okay. Sorry about that little technical difficulty. So this is an example of the type of asset that we're going to be looking at, and yeah. So the Fund 7 is targeting another portfolio in the same region, an even larger portfolio that's got similar metrics. This is case study 2. So this was in that same Fund 6. This was kind of a second acquisition for the fund, and what we would call kind of a bolt-on. We already had these 140 wells plus the 68 undeveloped location. We were able to buy another 29 wells at $10 million. There's some additional PEDs, so a smaller asset, but we were able to kind of bolt that onto the portfolio and increase the overall value of the portfolio. This, again, same has kind of bolstered cash flow, and then we've got these 5 locations, I think at least one of which we've already contributed capital towards. We got asset number 3. So this is in the Scoop region, so not on the Stack side. So this is based on the counties. These are the counties in Oklahoma where those are kind of the dividing lines. So this was in the Scoop region. So we're able to do, again, another bolt-on. This is, again, part of the Anadarko, and just another 14 wells gross. This was more of a diversification play and gave us some steady cash flow from existing. So it's a nice, added feature to this diversified portfolio. So prior fund performance. So this is Fund 6 that we're talking about here. So we raised $41 million to go take down all those assets. We layered in a bank line of credit through Bank of Oklahoma. So again, 2024 cash on cash distributions to investors have been 15%. So currently tracking at an estimated 36% IRR based on the current valuations of the portfolio. So you look at kind of current market conditions and factor in the discounting that's happened. And as you can see, our investors have been very, very happy. These are just a few that were willing to give us some testimony to share with you guys. So they've been very, very happy with this. Obviously, it's been beating projection, which we always do our best to do. But yeah, that's kind of how Fund 6 has been performing and has created a lot of momentum carrying into this next fund. So Upstream Energy Fund 7, what we're doing is just if you look at this from a return perspective, here's a summary, is targeting 25 to 35% projected returns. That's a combination of cash distributions over this 8 to 10 year period, in addition to a sale of our portfolio where we'll realize kind of an equity, have an equity realization on top of that. And we'll all kind of dig through the actual cash flow projections here. So what that equates to is about a 4 to 7x multiplier on your capital. So you throw, this is, at our fund level, Patra's planning to come in. We've got multiple share classes, so Patra is planning to come in with us and kind of have a fund available for you that would have a lower minimum, to my understanding. So I'll let her speak to that. So I won't talk there, but it's going to be this target returns. In fact, she can deliver potentially a little bit stronger returns through the discounting that she's negotiated with us. So that'll be something that you should sync up with her on.
Yeah. So what we do at our club is we reserve the spot that bigger, like 1 million, and so that we can, that the other investor can come in at a minimum of 50,000. So that's going to give an opportunity for everyone to get into like institutional high grade investment. And this type of investment, in the past, like a past few years, is only available to an ultra wealthy people. So this is going to be a great opportunity. And I really like these unique strategies in oil and gas. I mean, oil and gas in the past, they might have bad reputation, because if you just invest to one well, two well, and it's just getting into almost like a gambling, that if we're gonna find oil in the ground or not. But in this case, we are buying in the already developed, and we know that there is oil in the ground. But of course, there is still other risks involved. That's why Mike went over about that. But if you are interested, just reach out to me. I'm happy to hop on the call with you.
Also, Mike, we're talking about a 4 to 7x equity multiple. For the folks here, what I'm wondering, what I like to do is simplify as much as we can to cash in, cash out. And then there's a tax benefit here as well. So a 4 to 7x multiple of just investing in the stock market might look a little different than a 4 to 7x multiple here, where you're getting depletion deduction in the intangible drilling cost deductions offsetting the growth in the profit as well. And so how does that all
I'll simplify that. Yeah, so we'll I think we've got some slides on this, but I'll kind of go back and forth a little bit, but just to kind of show you. So say this is let's use $150,000, what this means in terms of cash flow and kind of equity. So 4 to 7x.
Can I add something real fast, Mike? In our last fund, the Upstream Energy 6, we were projecting the first year we were not going to be able to having any distribution, but we were able to produce 15%. Just for your information. So this projection, we try to make it very conservative. So
this is very conservative. Yes.
Yeah, so we
absolutely.
can, outperform what we are.
That's exactly it. That's exactly it. Yeah. So, I mean, ultimately, we underwrite, this 8 to 10 year period for a couple of reasons. So one, you want to make sure that you can hit, appropriate risk adjusted returns. 25, 30% IRRs are fantastic if they're over a long period of time. So you need to make sure that, that we can hit those, and we're not relying on, hey, we got to sell this in 3 years to hit a high number. So we underwrite a longer period because that IRR over time gets drawn down. So it's the difference between me saying, hey, Patra, I'll double your money. You say, great, how long? Well, 20 years. 20 years, that's not so great. If it's, 3 years, that's pretty awesome. So 25, 30% IRR is sustained over 10 years is a substantial result. So what we've modeled in is a combination of cash distributions. So what we call cash on cash. These will be distributed to investors. And this is a net to investor. And this isn't accounting for the tax implications, which we'll circle back to, but this just puts it in dollar terms. So you throw $150,000 in there. Year one is where we're going to reinvest all the cash flows into development. And what that does, it takes about a year for those to hit. and actually start producing. So that's where you see this big jump from 5% up to 18. So that's between year 2 and 3. Now we intend to, do everything we can to accelerate that timeline, but from an underwriting perspective, that's the expectation that we've set. And then you really see, then you continually add new production over time, and that's where you really start to see that ramping of cash on cash. So this is annualized distributions on a $150,000 investment. So if you look at it kind of cumulatively, somewhere between year, call it the latter half of year 5 is where you'll see dollar for dollar, your distributions would have equaled your initial capital invested. Now, that's not a return of capital, that's a return on capital. Those are distributions from income. And so it's not diluting your capital, it's still preserving your capital while you're getting all these distributions. And it continues.
How much of that is offset by intangible drilling cost deductions and depletion deductions?
Yeah, so you have three primary benefits. You have intangible drilling costs, IDCs, aka depletion, and depreciation. So depreciation is it's more of a nominal impact, but that's on equipment and things like that can pass through. Depletion you could think of as just a 15% reduction to the taxable basis from your existing production. Because it's consumed, it's not renewable, you get to reduce your taxable basis. So say the fund, just so we have round numbers, say the fund had $10 million in income. Depletion, if we did no other drilling, we did no new drilling, depletion would reduce the taxable basis from 10 million down to 8.5. So it's a 15% reduction. Now say we went and we drilled a bunch of, several new wells, we contributed capital to those, and we generated, say $5 million in intangible drilling costs. Now that would further reduce, like we've still been able to distribute income, but we've further reduced that taxable basis now to $3.5 million, but the income was 10 million. So you've effectively tax shielded 65% of very high growth, high income from any tax. That's all tax-free money. And so you're getting all these same big benefits, but it's reducing the taxable basis of the income. And
the depletion is based on a percentage of the revenue, generally speaking, right?
That is correct. Yeah, it's a top line.
So that means you have revenue. Let's say you have a revenue of 100,000 and deduction. Let's say you get your share of the net income is 80,000, but there's a total revenue of 100,000. So it's like you're paying taxes on less than 85% of the revenue, just looking at the depletion, because it's based on that revenue before all the expenses are coming out and the money comes in. So, I mean, this is some really, not only are you getting all your money back, but you're getting your money back in a way that is so much more tax efficient than anything you've ever seen in 100% your line of work.
And new recapture. That's the beauty. For those of you that are familiar with real estate investments, you can capture similar depreciation benefits, probably not to this level, but similar depreciation benefits, but those are recaptured when you sell the asset. And so you have to pay them back. Whereas in oil and gas, you don't, because it depletes over time, you don't have to pay any of that back. So all of that upside on the back end is it's tax shielded.
I think one of the analogy that you gave me previously, Mike, like almost like you are buying a real estate and existing real estate that comes with a land, right? So you already buy an existing real estate that producing income, but you have an additional land that we also can rebuild another building. That's going to generate more revenue for you. So in this situation, it's like similar concept to that. And most of the time, other traditional oil and gas strategies, most of the time they go to like empty land and trying to deal and get some oil and gas. That's how you can create the IDC cost, right? Meaning that you're probably not generating any revenue on the first year. And because it's almost like the way you take a look at it, it's like a profit and loss, right? In order for you to create a loss, that means you didn't produce any income. But in this strategy, it's only offset each other inside of the fund. And it's like you create revenue, but you don't pay any taxes on the revenue you generated. So that's like a true passive income without giving it to the IRS.
That's right. Yeah. Yeah. So that example, I'll kind of, right. That'll be passive income that, you got some of these other investments in real estate, et cetera, that generate some maybe passive losses for you. You can craft a portfolio with, folks like Mark and Patra to help you. This is a significant piece to your portfolio, giving you tons of tax efficiency, high income, all treated passive that you can then offset with some other things. So it's a fantastic strategy in that sense. But kind of back to that example I was giving you, Patra, was think of what we're doing. Like for people that it's a little bit easier to understand real estate because it's a building and people understand, it's an apartment complex. So basically what we're doing is think of going and buying a brand new, nicely new developed apartment complex, and it's already filled up, and you have all these tenants in there, and it's already generating a significant amount of cash flow. And then say you have 20 acres adjacent to the property, you've already proven the business plan, you already have operations there, you already have everything going, and now you're saying, well, why don't we just go develop another 100 units over here, and then we're going to compound the cash flow. Now we got more cash flow, but we also create this very valuable new asset. And so that asset, not only does it create income and equity, but it also has depreciation and all these other tax benefits that flow through. So it's the same type of thing, just without, no recapture and higher total returns and higher total cash flow because it's commodity based.
Mike, I got a question. Someone is asking that, Kesava asking that, can you explain about 730 waterfall split? 730 is.
Yeah, 70/30 is just it's a split. So that's based on the income. So if you got for simple numbers, we got $10 million in income. 7 million of that goes to our LP investors, and pro rata based on their ownership, and then 30% to the operators, us. So that's the way we make money. We have a very simple structure. We ourselves don't have an asset management fee. There's a contractual management fee that's paid to Mahajra, but that's kind of to fund their overhead for their geologists, engineers, et cetera, that are doing the work on the wells themselves and the due diligence, underwriting, asset management on those. So we pay a contractual management fee to them. All of these returns are net of fees. So it's not like hey, gotcha, by the way, there's extra fees. So it's very simple structure. Now, how this gets structured with somebody like Patra is, your community, say they bring us $1 million check. What we're providing is a discount on shares. So you're buying more shares, which is creating, a greater overall return. And so these waterfalls, technically, this is for kind of our common share class at $150,000 investment. You guys are getting a little bit better if you look at it. It's technically still 70/30 per share, but because you're buying more shares, it's increasing the split effectively. So that's how we've structured this to create that level of return for your fund and your investors.
Yeah, so I think that when I take a look at waterfall calculator, it looks like if you are investing to the structure is going to give you a little higher for the investor. You can put a minimum investment through our.
That is correct. That is correct. Yep, that's right. So I'm trying to think of anything else that's important. Oh, this would be important to note. So full alignment. So both Aspen and our co-sponsor, the partners from both firms, are co-investing their personal capital in LP positions. So on the same terms as all of our investors. So there's no, the full alignment. I mean, if you make money, we make money. If you lose money, we lose money, which we're certainly not going to do. So, so this is kind of your team. Here's our team. We've got 4 partners here at Aspen, and a long track record. We're about 600 million AUM and counting. With this fund, we'll quickly be at probably about 750 million this year. So we're continuing to add quite a bit of assets. Here's what our investors have to say about it. So they love us. We've been doing this for 12 years. If you want to look at our webinar, stuff like that, I think Patra will have some resources available for you. And then I think this is to connect with Patra if you want to talk a little bit more specifically. That's her QR code.
Hey, Mike, quick question. You ever see people, if you could like what, 9, 10x your investment in like 9, 10 years is, do you see people investing into these things with their Roth IRAs?
Absolutely. Yeah, there's
Yeah.
a strong case. Obviously, I mean, I always give the caveat, I can't give you tax advice, can't advise anybody, but if you look at the logic, there's a really strong logic here. There's going to be a debt component to this fund, so there will be some UBIT to consider. However, when you got high growth, high total cash flow, high total return with, call it 30% or below on the leverage ratio, that's a really strong way to grow your capital. So you're not going to take advantage through the IRA. You're not going to get the advantages of IDCs and all those things the way they pass through on a cash investment. But absolutely, it's another way to unlock some big upside through a Roth.
Yeah, I would think here also because you only pay the UBIT is where you're using other people's money or leverage or debt to have profit. And if you have profit, then they're saying, well, part of it isn't really the money in your retirement account, it's money you're borrowing, so you pay taxes on every dollar of profit. But at least in the earlier stages, because you have the IDC deduction and the depletion, you're not recognizing a lot of profit to pay that UBIT tax on the 30% of it. And even if there is some tax, heck, you're using other people's money, and then on the exit, you're paying zero capital gains on a good chunk of that cap gains, which is
That's exactly it.
Right.
Incredible. Yeah. So I think it's a powerful way to grow.
Yeah. And Mike, how much are we raising on this fund again? I know we
This
just
is
launched last Thursday, right?
Yeah. So the fund as a whole is initially $75 million that we are raising. It's not capped, so theoretically, if there's demand and we can deploy, then this could be upwards of 100 million. So we'll see where we land, but initially focused on the first 75.
Yeah, and we just launched out last Thursday. We already have like 20 million. That's is it 20
More than
million?
that.
More than that now. That's quick.
Yeah, I mean, each day, grows. So I think as of this morning, we're just shy of 30 million.
Wow. And I just spoke to you like 2 days ago. Was that 20 million? I know that this opportunity. It's like it's very unique and offer safer and high ROI. And also I think these strategies with other oil and gas, usually they're just gonna like use it all right until it's depleted. But for your strategy, you're getting a distribution and you also get an income from selling the wells to like the third party later on. That's how you get from the I think the chart that you were showing earlier. As you can see that at the end you get even more return at the end.
That's right. Yeah, that's exactly right. So you replace what you deplete through development, and then you increase, the development actually increases production, and then you consolidate a portfolio. So you kind of like I was giving you those examples of assets from Fund 6. Those were by this asset, by this, and we kind of bolt together a portfolio, and then and then you look to sell when market conditions are opportune, and you realize all the discount that you you use when you bought it. Because kind of out of favor right now, we can buy it at a discount and then the middle market roll up for larger capital who wants to create efficiency for
Right.
larger capital.
And then you know, compare that to what the taxes you're paying at your job or your business with ordinary income, and maybe self-employment tax, payroll taxes, you're paying more favorable tax.
Absolutely. That's why people want to come talk to you, Mark, because you get it. You got the give. So no, that's absolutely right. Well, I think should we open it for additional kind of Q&A for folks?
Thank you, Mike. Yes. If this is a good chance to ask Mike any questions, you know, things are alive right now, so if you ask questions, I say that Mike is
Yeah, so I mean, you're not going to have surplus. You have a sit here, so you're happy about how we can give some support to make that kind of like what we were talking earlier. Most of what's possible at the table in this space, bring your and reduce way. Freddy possible to say we'll develop between now to theoretically offset all the income and our tickers for you other passive income. It's not your look at, but a expansion over year, please, we can call it 70% of the taxable basis of the income that's being generated is actually the basis of which should be taxed. So yeah, it's hard meetings to know that.
One way is if you ask one strategic is like there's more capital invested in diversification and more good for tax savings. Yep.
And if you look at tax deduction, we can book a call, with Mark or myself, and we can go over it and how we can help you. If you like, up to open tax deduction to 25, we have to help on that. Because there are several advanced strategies you can help as well. And I think now, Mike, I think by that, you know, like what have you how best this is and what is it that you can play? What is that coming into it?
Yeah. So these, that's a piece of the prove out well. Those we like these developed this well in the past, and then at that time they would bifurcate or split the interest in that lease. And so we're not on the front end when we buy into PDP, we're not buying it from the operator. We're buying it from somebody who already owns that split interest of the lease that they've bought in the past. And so we step into that and we get to value that as it is today. And so a lot of times that's other private equity, say they have a fund and their fund is sunsetting and they need to sell off this portion of their portfolio to close the fund. So that's a common example. Sometimes it's an operator who, they're a big operator and they just have this small portfolio. It's, what we're buying. And if you look at it in the spectrum of the industry this is a fraction. I mean, we are not a big fish and these are not enormous assets. I mean, we're dealing with lots of money, but it's not, in the scheme of things, it's not that enormous. And so when we step in to buy from an operator, this might be just a very small portfolio where it's non-operated. And that's not really fits with their core business. They want to free up some cash to go do some more stuff where they're making more money. And so they might, be willing to sell that. And we're buying these off market. We're sourcing these through our relationships, mostly through Mahajer, who's been in the space for a long time. And then we'll go direct and we'll buy that existing. And by buying into that existing, then we get access to then create new partnerships with those same operators for these new wells that are being developed. So kind of you pay to get in, and then by paying into that existing production, now you have access to then contribute capital for new development. And then that relationship just continues to grow and flourish.
Right. So with a big operator like that, they already have big capital, why would they want to sell the non-operating working interest to us?
Yeah, I mean, well, they've already done it in the past on the existing, so that's why, because it already exists. And then on the new, they want to diversify. So, I mean, one well might cost them $20 million. So it's very capital intensive. So they're looking to diversify their holdings themselves. And that's money that they can reallocate to continue to diversify their well count and their footprint. By them having interest in 100, they're the operator on 140 wells over here. That's a fraction of their total portfolio. And so they're looking for diversification in a very capital intensive industry where, by bringing that outside capital in, they share the expense, they share the load, and it allows them to spread their dollars and put them to work. So that's why they would do it. And as we talked about earlier, a lot of the large capital, those pension funds, because of ESG, are gone. They're not spending the money anymore. So now they need to go find other sources.
Yes. And how many ways you can invest into oil and gas? Mike, I know that there is you can get royalty income, you can get non-operating working interest. Can you talk more around that area?
Yeah, basic structure is you have a mineral rights owner. So this is somebody who generally owns land, and then as a result, they own the rights below the land. And they would sell off the mineral rights to an operator. That operator does the development, and they do the day-to-day drilling. That mineral rights owner would get a royalty on the production. So it's kind of off the top. They pay a royalty, kind of through their lease, basically. And so that's a little less risky as long as there's production. Like, if there's not production, then mineral rights are kind of, worthless. Like, the rights at my personal home are worthless because there's no production happening, right? So if done well, that can be a great way to mitigate some of the operational risks. You don't share the operational risk where if something went wrong on a rig or something like that, or there was higher expenses, it doesn't matter. They're getting paid. So they're kind of, think of it as they're the landlord and they have a triple net lease. And so they're just letting the tenant occupy the building and pay them a set payment, basically. Then the operator is who's doing the drilling. So that's the leaseholder. And then you have these non-operated working interests, which is the split interest, which are more passive investments into the working interest, which is doing the drilling, and that's where all the tax benefits are. So that's kind of the basic structure: is mineral rights, operator, non-operated working interest. There's some other ways, but that's, if you're looking at it on the actual production side, that's commonly what you see.
Right. And another thing to interject to that, if you invest as a royalty, and you're not going to get any tax benefit on that.
No tax benefits. Yeah, no tax benefits.
But we are investing on the second option, which is an operating working interest. And what about liability risk? Like, if something went wrong with an operator, is it anything that's gonna flow through to us as an investor? As a passive investor?
Very unlikely. Theoretically, is possible. You'd have to have a pretty substantial liability that was generated, but no. In Mahajar's history, they haven't had that happen because you have layers of insurance per well. So we participate in the operator's insurance. So you've got not only the assets of this publicly traded company and all of their legal structures, et cetera, but you also have insurance layers in between. So the likelihood of something going wrong to magnitude where those liabilities would exceed the coverage and exceed the assets of the operator, very unlikely that it would land with kind of the more passive, non-operated working interest.
Right. Anyone else have any question? Because otherwise I'm just gonna keep asking all day. So I would love. Yeah, I'm good at asking questions, and when I talk to Mike, I'm just asking him a lot of questions. He's probably tired of me by now.
No, all good.
Thank you. Yeah, I know that you just came in, and know that you missed a lot of presentation, but don't worry, I will send you the recording. But anyone have any questions? Come on, Camila Kesava has a great question earlier. You're gonna give a few minutes. Okay, but if you have any other questions and you want to book a call, Ala, is this recorded? Yes, it is recorded. We're gonna send out the recording after. Give me about a few days for my assistant to put everything together. I will send out the recording. And if you have further questions and you wanna have like one-on-one call, just feel free to book a call with me, or you already have my, my email at or if you want to talk about taxes, market here, we can also you can book a call with myself, and I will send the outcome. I wish everyone watching today, and also of course that will answer all questions. And I hope everybody have a good day, and hope we see you next week. But I think we talk about self-directed IRA, how to use your retirement to invest, right? Especially, with the stock market, it's very volatile, and you wanna diversify your portfolio and not just depend on the stock market. And sometimes we may not have a liquidity. We can use your retirement 401k to invest into like oil and gas and real estate as well. So we're gonna talk about that. But for the date, I will confirm back to you later on.
Also, I know a way how you can use oil and gas to offset up to what I've seen up to 50% of the taxation on a Roth conversion, but you're not going to hear about it unless you show up to the next meeting.
Yes, stay tuned for our next one. Thank you so much, everyone. Bye.
Have a good one, you guys.
Awesome. Like 2 persons. Harati.
She is a CC.
Hi, Arati.
Hi.
Hey, how you doing, Roddy?
Yeah.
How are you, Mark?
Doing good. We were talking about an investment that just came out in oil and gas and breaking down the numbers. It just ended, but it's good to see you.
I had sent a message that I'm going to be late because I had a client meeting.
Yeah.
As soon as it got done, I joined in, but I realized I'm late again.
That's all right. Don't feel bad about that. What we can do is we have a recording, so we can send it to you.
Oh, that'd be great. Yeah.
If you have any questions, you can book a call with me or Mark separately, and we can walk you through. But just make sure that you watch it, because it's a lot of good information in there, and it's a way to create passive income that you can also help your clients too.
I'm excited. I would love to watch it.
Yeah, but nice to meet you. I don't think I met you yet. Are you from CTC?
Yes, I'm from CTC, and I've known Mark for some few years now. Yeah.
Yeah, awesome. I hope I get a chance to meet you in person.
Yes, hopefully this year in North Carolina.
Charleston, South Carolina.
Oh, South Carolina. Oh my gosh, South Carolina. My geography is all over.
Where do you live? Where are you?
I live in Minnesota.
Oh, okay. So you're East Coast, right?
Well, Midwest.
Midwest, okay.
Yeah. You're in Atlanta, I believe.
Yes, I am.
You can tell by her Atlanta accent.
My southern accent. That's funny. So, but next month we're gonna talk about self-directed IRA, how to use your retirement to invest into alternative investment.
I am very interested in that.
Yeah. We'll send you. I think you already registered in our.
Do you have a date already? Because I want to make sure I block my calendar and I don't have an overlapping appointment. Do you have a date for that?
I have not finalized the date yet, but I will take a note that I will reach out to you.
Okay, that'd be great.
Yeah, or add you into the calendar invite. You use a Google Calendar, right?
That sounds great. Also, Mark, do we have the Wednesday call today or no?
Oh, I think that was last week and no one showed up. I just stared at myself.
Oh,
Oh,
Yeah, I was there. No one else showed up.
oh, do we have it today?
No. Today I'm booked. I'm doing a podcast with Tom Gierzinski
Oh,
and
okay.
then meeting with the client. Yeah.
Okay, and is that podcast open to people?
This one we're doing it on a separate platform, so it has better quality. But you'll have access to the recording.
Do I have access to what?
I'll send you the recording.
Oh, that'd be great, Mark. Thank you. Thank you
but
so
email him sometimes he forget because sometimes I ask him to do it too, and everybody just ask him, then he forget. Just email.
Okay. Okay, I will.
Yeah, my
I'll
sister
send a
sees my
reminder.
email, so that's
Okay,
easier.
great.
Yeah,
Good luck
but-
with the podcast, and I await the recording of today's webinar.
Yes.
Okay.
I will
All
send
right.
you.
Thank you. Have a good
Bye.
season. Bye-bye.
Yes, bye.
Bye.
I gotta head out.